Ryan here, local mortgage expert. I'm on Quora today answering questions for everybody that is in regards to mortgages, real estate, things of that nature. So let's dive right in and answer some questions. So the first question I see here is, how do you prove the source of funds when buying a home with cash or with gift funds? This can be a little bit tricky. Most lenders are going to need to verify the funds coming into a transaction for the last 60 days. So if the money is just cash, most of the time we're not going to be able to use it. There's plenty of anti-money laundering laws. There's suspicious activity reports, all kinds of things that govern the mortgage industry, and cash just frankly usually can't get used. So it is something where you want to get that cash into an account and let it sit there for 60 days. Now, gift funds in this question should be a verified source if somebody's giving you gifts, unless that's also cash. So if it's a bunch of cash, you really can't use it. There's really no way to prove where that money came from unless it's been in the account for a long enough time to seize it. So you want the cash to get deposited into an account. The only way I've seen people get around this is if the family member already has the money in a verified account, then you can give them the cash and then they gift the money they already have verified. That's the only other way to kind of get around that, but you're really not trying to get around it. It's just you have to verify where the funds are coming from. So that's you really can't use cash. Short answer, you can't use cash. Let's see. Let's see. How can someone buy an expensive item like a car or a house if they don't have a job or income? You don't. I mean, there is programs out there that do allow stated income, but you have to have a lot of money down. So there is programs that if you just don't have a long enough job history or write everything off, if you're self-employed, if you have enough down payment, the credit scores are high enough, there is some lenders that will do that. But generally speaking, if you don't have the job and the income to support the payment, you're not getting a loan. Or if you do, the terms are going to be pretty ugly. Let's see. Why do homeowners insurance policies often not cover relatively minor issues like leaky faucets and clogged drains? It just comes down to the cost. There is warranties that are out there that are probably cheaper than like homeowners insurance. So you can check into that type of thing instead of an actual homeowners insurance policy. But if it did cover all that stuff, the premium would just be a lot higher because now they're covering more. So most homeowner insurance policies are more on the catastrophic end of things, where if it's a fire or major theft or something like that, it's not really designed to cover leaky faucets or drains or stuff like that. And if it did, it'd just be more expensive. So usually homeowners insurance policies, you can write that stuff in, it's just more expensive, or look at a home warranty. Usually those will be a little bit cheaper way to cover those items. Let's see. Can you refinance your home without getting another loan from the bank that gave you the original mortgage? Great question. You don't need to use your current lender. You don't need to, and most of the time, the lender you're working with is actually the one that bought the loan. So they didn't even start the loan in the first place. It was securitized, pulled with a bunch of loans, and then sold off to the servicer. So very rarely is it the very initial lender. It's usually a new lender anyway. So getting a new loan with them doesn't mean you're going to get better rates and terms, doesn't mean you're going to get better interest rates or less hoops to jump through, because generally speaking, you have to follow the new guidelines, the new regulations, especially if you want the better interest rates. If you're using the same lender, you may not be open to all the other lenders out there that are looking for the business. You may not get the best rates and terms using your existing lender. Now, obviously, they're going to try to save you money on maybe appraisals, and maybe they've got some documentation to make it a little bit easier. But if you did the loan 2 or 3 or 4 years ago, they're still going to need all the income documentation, pay stubs, W-2s, tax returns. They're going to need all that stuff again. So it's really not any easier or cheaper to go with your current lender. In fact, I'd recommend checking like us, use us to be able to help you with your mortgage loan. Let's scroll down here, a couple other ones. What is the subfloor in a home renovation? So that's just the very base floor before you layer it on top. So that's just the subfloor. Let's see. Let's see what else. Oh, can you sell a home with a balloon mortgage? So just like a balloon mortgage, a fixed rate, a reverse mortgage, they're all liens against the property. So they just work differently in case of foreclosure or how the payments work. So you can easily sell a home before the balloon payment. It's just if you don't get it sold or refinanced before that, you'll have a large kind of a balloon payment that's all the balance all at once. So you can sell. That's one way you can pay off that loan or a refinance. But It doesn't restrict, it doesn't mean you have to wait till the balloon payment before you try to sell. It just means that you only have that much time until that big payment is due. That's why they call it kind of a balloon payment or a balloon mortgage. Here's a question. What if subprime loans never existed? So that name definitely got a bad rap because it got abused. It was so much money was getting thrown in the mortgage industry. They were just doing crazy loans. They were doing loans with very low credit score, no money down. In fact, they were doing loans above asking price or above the appraisal because of how much appreciation was happening. Just so much money was getting thrown at it that subprime got bad, kind of a bad rap. But I think that that loan program does exist. There was benefits to having that loan in the marketplace. For instance, if you got an 800 credit score borrower that's been self-employed the last 10 years and writes off all of his expenses, so his taxable income is very low, but he's able to put 30 or 40% down, why would you not want to do that loan? Well, for a long time, those loans just basically got stopped because the market wasn't buying them or stopped just because of regulation. Just said you can't even do that loan anymore. They are starting to come back. They're now called non-QM or qualified mortgage. So if it fits this certain criteria, then it's a qualified mortgage. If it doesn't, then it's a non-qualified mortgage, which means there's not as much protection built into the marketplace if those loans happen to go bad. So I think it's kind of throwing the baby out with the bathwater. They got rid of all these subprime loans, even though there's some that made sense. It's like the percentage of them that got abused threw out all the other ones that weren't getting abused. And now the market's kind of coming up with new terminology to kind of bring some of these loans back. Now, I don't think we're ever going to see what we did that led to the '08 crisis as far as the type of loans that were being generated, but there are starting to come back on the make sense deals. Some of these deals make total sense. It's crazy that we can't do a loan for certain clients because it's considered subprime or non-QM now. So you are going to start seeing these programs come back. Can I do a cash out refi with an interest only loan for an investment property? Yes. So the rates are going to be worse whenever you have the better rates are purchase. When you first buy the home, that's going to be the better interest rates, regardless of loan to value. They're usually the kind of the bottom rate. And then you have hits to the rate when you add levels of risk. One of the levels is the occupancy. So you're going to have a higher rate on an investment property than you will on a primary residence. And people often ask, well, why? Is that, it's cash flow, you got somebody else making the payment, you don't have to worry about it as much in your debt ratio. But let's say that person trashes the house or doesn't want to leave or has issues with paying rent on time, and all of a sudden you have to make the payment now and you lose your job or something happens, you're more likely to miss the payment on the rental property than you are on your primary residence. So they just go into more foreclosures more often. So because of that, there's higher risk to a lender that the house isn't going to be maintained as well, or that payments are going to start getting missed on that. When you start adding refinance or cash out refinance, it just adds a level of risk. To offset the risk, they raise the rate. So the program definitely exists. You can do a cash out refi on investment property or a second home. They're just going to restrict how much they're going to loan as far as a percentage of the value, and the rates are just going to have little hits as they go up that ladder. So it's just going to be a more expensive loan than if it wasn't a cash out or wasn't an investment property. Let's see what the next one we got. Okay, let's see. We'll do a couple more here real quick. Should I use points to buy down the interest rate in my mortgage if I plan to refinance in the near future? So I've heard this a lot. As rates have moved up, people are like, well, I can just always refinance. Well, that's also expecting that rates will go down. What indicators in the market do you think rates are going to go down? Just because they were lower at one point? But look at all the forces in the market that drove interest rates down. There's way more forces in the market now to keep raising interest rates up. The spending, the supply chain issues, there's still a lot of things that are going to keep interest rates up. So I wouldn't just do a loan, buy down the interest rate, knowing that I'm going to be able to refinance in the future. If you can, it's a bonus. You always got to look at, it's just a bonus if rates go down, but you want to be as comfortable as you can with the payment that you have. So whether you should pay points or not is really the easy calculation. What you'll want to do is take what the payment is before the buy down and what the payment is after and minus those two numbers. So let's say it saves you $50 to be just as an easy number. Then you take the cost to get the loan. Well, if it's $5,000 to save 50 bucks a month, where is the break even point? Well, you're 100 months. If you're not going to be in that home that long, you might be better off not buying it down that much. But here's another tip I would give you. A lot of times rates can be pretty close to each other with little differences in the fees, but every once in a while there'll be this weird jump where, say, 6% is 1 point and 5.875 is maybe 1.2, and then all of a sudden it's 2 points. It jumps a lot. And a point is a percentage of the loan. So 1% is 1 point. So if you're half a point, three-quarters of a point, you're a percentage of the loan amount, not the sales price. So it is a percentage of the loan. But that's a really good way to indicate where the break even point is. If it's 3 to 5 years and you don't plan on keeping the home that long, regardless of if you could refinance, if you don't plan on keeping the home that long, then you may not want to look at buying it down. Now, maybe you know that you're going to have to upgrade because you're having more kids, or you want to move into a different school district, or job changes, any of those things that it's not going to be a long term or kind of a forever home, then that is something where you don't want to do the buy down, or just figure out where that breakdown is. But just saying, hey, I'll just refinance if rates go down, great. If they don't, what do you do? How long do you plan on keeping the home with other factors, not just being able to refinance? So I hope this was helpful. We'll do this a couple more times. We'll check on Yahoo Answers and Quora and try to get some comments and try to get some ways to answer questions. But if you have any questions, please put it in the comments. Maybe we can make some more videos on the comments that we get. But I'd love to help you or anybody you know with answering questions about real estate. So hope you're having a wonderful day, and thanks for watching the video. Click and subscribe for our next coming videos. Thank you.